I think what we saw in the last year was the early stages of the bond market actually taking the printing press away. I mean, it did what it wanted to. It all got ascribed as predicting future rate hikes. But what happened was the bond market took matters into its own hands. It tanked. And then the Fed followed it, and then things went and they broke, and now the bond market rallied.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. From a macro standpoint, the storm clouds appear to be multiplying in number and darkening in intensity. But the markets seem to see only sunny skies ahead. The NASDAQ enjoyed its best quarterly gain in Q1 since 2020. Which outlook is more correct? To help us find out, as investors have a lot riding on the answer, we have the good fortune of speaking with investor and analyst Bill Fleckenstein of Fleckenstein Capital. Bill, it's wonderful to see you again. Thanks so much for joining us today.
Well, thanks for having me back, Adam.
It's always a pleasure, Bill. Look, lots to talk about. Before I dig into the specific questions I have here, let me just start with the one I always ask you at the beginning. What's your current assessment of the global economy and financial markets?
Well, I think I would say the G7 countries are in the process of slowing down and entering into low-grade economic real growth. Whether it's going to when it's going to exactly be recessionary, I can't say. You know, when you have a nominal number that's high and inflation, you know, you can be net zero real growth and not be able to really tell so easily. So, but certainly the financial disintermediation that is taking place today and the blowups of the banks that have occurred and the recognition of the weak hand that so many banks have to play, it is going to be a serious headwind for the economy, you know, credit creation, in addition to the other issues that are already there. So it appears that China is accelerating, and maybe it'll drag a few other Asian countries with it. I don't know. I don't really trust the Chinese economic data, and I don't have an opinion, but it does seem to be that's what's going on there, and that may have an impact. So you could have, some places doing quite a bit better than others, but we'll see.
Okay. And just real quick commentary on the markets, given that global economic.
Yeah. Well, yeah, there's the markets. Well, you know, obviously the equity market is probably confusing to anyone with a decent amount of common sense and knowledge of history, because given the litany of problems, one wouldn't have expected this strong of a rally right out of the chute, although, you know, in the first quarter, but you know, there's still passive flows which are working. Obviously, the bond market is not as weak as it was because of the fact that the Feds had to respond to the banking issues, and therefore the market took that to mean that maybe the Fed hikes are almost done. I think they're done. I think events are going to overtake them. They're done hiking. They're done hiking for this part of the cycle. They'll have to hike again down the road, but that's another issue. So events are going to overtake them and have started to overtake them and will continue to overtake them. Events such as we've already seen them break a few banks. This disintermediation will continue. The world now seems to be much more cognizant of the fact that there are bad marks out there. They woke up to it with the fact that a lot of people learned probably for the first time that banks can hold things to maturity and pretend like they're at a different price than they really are. And the same thing, there's bad marks in commercial real estate, which is now getting a fair amount of press, and in venture and in LBO land, so-called private equity. So I think that there are a lot of dominoes that can tip over on each other. Now the Fed has started to break something, and you know, when you're levered as we are and have had as much speculative activity, the combination of the leverage, financial leverage, which is not as bad as it was in 08. I don't mean to imply that, but you combine that with a lot of the speculation that occurred in the wake of the lockdowns and the free money. You have a pretty large group of potential targets of things that could tip over. So I think that the outlook for the stock market and the economy are weaker. The tricky part about the stock market is we don't know, how, the Fed has obviously raised rates, and it was doing QT slower than it should have been, but doing it. Now it's doing QT maybe a little bit, but its balance sheet just blew up because of what it had to do for the bank rescues. Now, it's this new stuff is not QE. It's not the same as QE. The market some people might have read it that way and jumped on board. It helped the market action look better than it was going to. But it's not stimulative either. It's just nowhere near as powerful as QE, right? Had they let Silicon Valley Bank go the way it looked like they were going to, we would have had a tremendous undertow in a lot of places across a lot of fronts. They didn't. So we don't have that undertow, and now you get a little bit of stimulative relief from these banks being able to pledge securities at par that might be worth a lot less than that. So it gives them a little breathing room. Doesn't mean the bankers are going to make more loans, but they might not make a lot fewer loans. Do you know what I mean? So at the margin, it's stimulative, even though it's not QE.
Okay, stimulative, but not nearly as much as true QE.
Not like handing people free money. That's stimulative.
Yeah, and just to help people understand this, so when the Fed does QE, it's buying assets directly from banks, mostly from the primary dealers.
Let's talk about that for a second, okay? Yeah. Because one of my pet peeves, I have a lot of them, but one of them is when people say, well, it's QE, the money goes in the banking system and it stays in the banking system, like what goes on in Las Vegas stays in Las Vegas. Mm-hmm. And that's just not true. And I have some smart bond friends who maintain that is true, but it's really not, because what happens is the Fed injects money into the banking system. And then, the whoever owned the bonds that the Fed bought, now it's got cash. Now, what are they going to do? They might buy a different set of bonds, but they might take that set of bonds at a price off someone's hands who might buy equities. And that other fellow that bought the equities might push up the price of something, and then the price of the stock goes up, and all the stock options that people have been given now all of a sudden come in, and then the company buys back those shares. So in a roundabout way, the company has benefited from the overall stimulus, but as the money worked its way into the system, went from the banker to somebody else, and then the next thing you know, the fact that the equity market went up allowed employees to get their stock option compensation, which isn't counted as compensation, which is another stupid thing. So QE leaks its way into the economy for sure. It's not necessarily direct bank credit creation, which so many of the people that think that what I just said is wrong believe, but it does get in there. And
you're saying there are these second and third order effects.
Exactly. It's like, ask yourself why, when the Fed would ease, back before they printed money and they just lowered rates, it would have a knock-on effect. There would be a knock-on effect, right? And those things are certainly true. Not to leave out the psychological factor, which what people think it means, and so they behave in a certain way. So anyway, QE is powerful. This was just a palliative measure that makes things a little better than they would have been.
Right. And one of the things that makes what the banks just did not QE is that the fact it's not an asset purchase where the bank is then sitting on cash that can do whatever it wants with. This is a loan, right? The money that the Fed is giving to banks here has to be paid back, so that the banks can't just turn around and do whatever they want with it.
Right. No, but in the interim, it allows them to pursue decisions that might be more normal than if they were in fire sale mode trying to save their balance sheet.
Right, which is why it's still marginally stimulative. Yeah. Okay, great. All right, so this is a good segue into the first main topic I want to dive into with you, which is the Fed. And you are, you don't hide the fact that you're not a huge fan. So, number of questions for you, but I want to start with this recent quote made by Nouriel Roubini. I want to get your thoughts about it. So he says, central bankers engineered a systemic addiction to easy credit while delaying the pain from the 2008 derivatives crash. In the process, they fomented the very inflationary/stagflationary disaster we are facing today. There is no such thing as free money. Someone somewhere will eventually have to pay the price. This means that central banks have two choices: hike rates or keep them higher, strangle liquidity and watch as various banks and companies drop like flies, or return to near zero rates and let the inflation avalanche unfold. So far, it would seem that the bankers are choosing to keep rates high, and Roubini notes that they may very well be forced to continue forward with QT as labor market issues push wages higher. And he says, in either case, the only possible outcome is a hard landing. The fantasy of a soft landing sold by many in the corporate media for the past year is being abandoned. So I'd love your reaction to that.
Well, there's a lot of things that he said there. The one, I mean, I think a soft landing is, fantasy, but I think a hard landing from where we are right now is not a slam dunk. And I'm only keeping an open mind because I keep thinking that perhaps the Fed isn't tight enough. They haven't, they were pretty slow on their QT process.
Yep.
And, it's been a long time since people have seen a period of sustained inflation. So now, the Fed's done what it's done. We're going to go into a period where sometime in the next group of months, there's going to be the base effect. And so the rate of inflation is going to come down on a year over year basis, even if over 2 years, it's still quite elevated, right? So, and one day, even though the people are kind of hoarding labor to some degree, more than they would have in the past, for sure, we're going to get a softish labor report. I mean, the data is no good to begin with. And when they have, this was kind of distorted to the upside starting out in January this year. So we're going to get a soft report. So that'll give the Fed the latitude to try to say, well, maybe we've done enough for now, right? And it's possible maybe the economy limps along. Maybe we go in the stagflationary period where inflation's 4 or 5 and GDP is about the same, right? So no real growth, but inflation. I'm not so sure if the stock market tanks there, because a lot depends on what the bond market does, right? And you still got the passive bid, which, makes the market not trade the way it would have. If you could go back in history and find the exact same set of variables, which of course you can't, but if you could, and there wasn't the passive bid that comes from BlackRock and Vanguard, not talking about the ETFs, I'm talking about the passive retirement money bid. I would bet serious money the stock market would be one hell of a lot lower. But the fact that helps keep it bid, and then it absorbs some bad news. So then you get some people to say, well, maybe things aren't so bad. And they pile in that kind of, I'm trying to explain how we had this rally this year, especially when people's expectations were so low and maybe people were set up sort of bearishly. So now you've had this period where we've had a pretty strong, reasonably strong tape. Now we're going to go in earnings season and we'll see where the rubber meets the road. Will earnings be able to be good enough to hold up the market? I don't think earnings will be special. I think there'll be a fair amount of disappointments. Will people care? Will we see a second quarter swoon a little bit like we saw last year? At least I think it was down last year in second quarter. I think we could. But then does the bond market behave better? And does that kind of arrest the decline in stocks because people think the Fed is kind of done? Yeah, I just don't know. When you have this passive bid under the market, you're really talking about at the margin what's going to happen. And so it's a little trickier to have a scenario that you have a lot of faith in. You can say, I have a few different variations of outcomes that make sense to me, and I'm going to look and see which one I think is playing out. It's kind of where I am.
Okay. Well, so look, first off, I don't envy the Fed, the position they're in. I don't think you do either.
No, wait, they created this for themselves.
I know you have no pity for them. Exactly.
That's like the people. I'm not going to go there. But, no, they created this mess. They have no self-awareness. It's zero. This guy Cash Carey is the worst. Yeah, he was begging and begging and begging for more inflation. Now and then didn't believe in it. Now he wants to talk like a tough guy. These guys are anyway. You don't need to hear me rant. I'll stop.
Yeah. Well, like as I said in the intro, I know very well you were not a fan of these guys. That being said, I wouldn't want to be sitting in their shoes right now. So one of the challenges,
because to actually do the right thing would be extraordinarily painful, and it's going to take a long time to set things right.
Great. And actually, help me remember to come back to that, which is like what you think the right thing would be, right? If I made Bill Fleckenstein emperor, but let's not go there yet, because I got to ask you a few contextual questions here. So, as Rubini said here, he said, look, really the big thing that's making now different than the previous past couple decades for the Fed is they're being checked by inflation, right? Mm-hmm. And just, a couple days ago, OPEC just initiated this surprise production cut, right? And here we are the day you and I are talking here, and oil's up, $5-6 a barrel right now, right? So it's back above $80 a barrel. That is going to be inflationary for as long as oil prices remain high, and maybe grind higher if those production cuts get increased at all at any point. And Bullard on the Fed said, this caught us by surprise. Some of that might feed into inflation and make our job a little more difficult. So, Powell is trying to get inflation under control. He took way too long to start tightening and hiking, but he did, right? And now things are starting to break, right? We saw the weaker players in the banking system. We had some bank failures there. We've got perhaps OPEC not helping the situation now, dialing the price of oil back up. When Powell spoke last, which was a week or two ago, he kept reiterating 2% is our target. That is my goal here, is to get inflation back down to 2%. He wasn't walking it back up yet. He's basically lashed himself to the wheel and said, I'm going to do whatever it takes to get inflation back down to 2%. The market is saying, don't believe you. The market's pricing in several rate cuts as of this year. Which one do you think is likely to happen more? Because I know you said you think he's done hiking, but he could pause for a long time. I think that actually kind of is his plan. Question is will he be able to? Because the market certainly doesn't think he can.
I think he's done hiking for now. When I say now, I'm saying this year. Okay. Yep. Or for a group of months, because events are going to overtake him. The data is going to go in a way that allow him to soften up. We'll maybe have a couple more, maybe something else will break, maybe something that'll happen. I just don't think they're going to be hiking and going to feel the need to hike. Again, it's easy to talk tough. Now, Adam, I know you work out. I see some of your videos. I mean, I used to be a CrossFitter myself. And a lot of guys are going to say, well, look, yeah, I'm going to get so I can do 20 dead hang pull-ups. Well, how many can you do now? Well, I can't do any. Well, you're going to have to spend a lot of time in the gym and hard work. You'll get there. And, most people, it's a lot harder than they think. And when it gets really hard, a lot of times people stop doing it, right? Mm-hmm. Yep. So I'm using a physical world analogy.
That's a great analogy.
It's easy to talk about. I'm going to do this. I'm going to do that. And people paint Powell like the second coming of Volcker. I mean, that's ridiculous. Just ridiculous. I mean, he helped create this mess. And look at his predecessors. He maybe looks good compared to Yellen and Bernanke, but now that Yellen's the treasurer, and she said some of the things she said in the last couple of months about the banking system, you can see how little grasp she has of the overall picture. Anyway, back to the market. You were talking about the bond market. Another one of my pet peeves is when everyone writes everything that gets discussed about the bond market seems to be whatever the bond market did on whatever the news, it gets written as how many rate cuts or hikes did it price in out over the next group of months? Mm-hmm. That's the current way it gets described. Well, let's pretend that didn't exist. People would say, well, the bond market was up today because it looked like inflation pressures were abating or the data was softer. And the bond market would be allowed to bounce around on expectations of what people had about how it was going to play out. Remember that a lot of people have different perspectives in the bond market. Some people care about the next 5 minutes, some the next 2 weeks, some the next 5 years, some the next 20 years. So you've got all these players and all this data and all the influences. And to think that every single day, the net effect of all those is some game where we're trying to decide where the rate hikes are going to be 6, 8, 9, 12, 18 months. That's just ridiculous. What happens is the bond market moves, it sets up a price, and then you can say, well, based on where the 10-year is today, in 5 years, that means that if the yield curve has a certain shape, that the Fed funds rate's got to be this. And since the Fed funds rate is somewhere else now, we're going to impute hikes or cuts based on that. So you can make up every day there's motion. You can say that we've priced in or not priced in more stuff. More hikes or more cuts. But do you think really people are thinking about that all day long? No, they're reacting to the data, and the curve takes the shape it does based on what people think the outcomes are going to be. So I bring that up because when you describe it the way you did and the way the media tends to, is that, well, all that matters is the Fed. The Fed's in charge. I would argue the Fed's not been in charge. The market was pricing in the fact that the Fed was way behind the curve for quite a while. Then something broke. People thought maybe there's a little run to safety. Maybe thought the economy would get worse. Maybe think inflation will come down. Maybe they're gaming the rollover in the data. Inflation is going to cool and guys are playing for a rally over the next 3 or 4 months. All of those things are more likely than pricing in a new level of rate cuts or rate hikes. So I got off on that rant. Now I forgot what the question was.
Well, so the main question boils down to the fact that Powell and the Fed are still committed to fighting inflation. Recent developments like the oil production cut are inflationary, right? Yeah. So it's making them, they've got to commit even more. But if you look at the bond market, it seems to be suggesting that the Fed is going to be cutting later this year. And so there's a real mismatch between what the Fed is saying and what the market's expectations are.
Yeah. Some people played for a rally in the bond market, and it made it set up in a way that looks like you can make the argument the Fed's going to cut later this year. That's right. How I would say it. Anyway, I think the OPEC move is a negative for the U.S. as a country, because it's like the Saudis are saying to us, look, apparently there was some sort of behind the scenes deal that we would refill the SPR if the prices dipped to where they did, and we didn't. So the Saudis are now kind of thumbing their nose at Biden, saying, look, you didn't keep your word. The fact that they're willing to do this just goes to show you, that some of the fecklessness of the administration is now starting to cause problems in other areas. Mm-hmm. I think that can spill over into the dollar a little bit too. And, this BRICS plus, they're making progress. I'm not saying there's a replacement coming for the dollar, because I don't think that's true. But there are things that might make people want to own them less. Be less eager to own dollars. And so I back to the economy and the OPEC and the inflation impact. Yes, but I'd have to go look and see where we were year over year. So we got to look at refined products and the whole stream of stuff that comes out of a barrel of oil and say year over year, is that going to add inflation pressure right here, right now, or not? I haven't looked, so I don't know. But I think the Fed is going to be more focused on, there's going to continue to be pressure in the banking system because disintermediation is going to continue. We saw this in the 80s when they jacked rates, and money funds came into existence. Money just kept flowing out of the banking system. Well, so people are going to keep moving that money. So that'll create pressure in the banking system. I think the Fed can easily rationalize the OPEC. They can say, well, we'll see what happens. It's not like the market did it. They did it, so yeah, it's going to create inflation, but are we going to, hike more because of what the Saudis did? They can rationalize their way around that if they want to, I believe. And I think they're going to want to.
Okay. So I guess the core thing I'm trying to get to here is, let's say you're right. Let's say the Fed stops pausing, right? And another reason starts pausing. They stop hiking, they pause. Powell has said, I want to stop hiking soon and pause. And I'm probably going to pause for like the year, like into 2024, because I want to wait to see the lag effect of all the hikes they've done.
And to be fair, that's not unreasonable. When they took forever to start moving, now they've moved a lot. It's not unreasonable to say in an isolated case, we've done all this. Let's kind of see how it sorts out. We've done a lot. That's a fair statement, I think.
Yeah, and I've been actually saying for months, I think that's the right course here, right? I think he should pause. In fact, I think he should have paused a while ago. Just to make sure he's not in danger of over tightening. But let's find out. You can always turn things back on again, hiking wise, if you realize that it wasn't. But where I'm going with this is the market seems to think that he is not going to be able to pause for very long. And kind of the big question I'm trying to get to is what would cause him to start cutting rates, to pivot, right, which the market's been hoping for a long time. And a question that's been posited on this channel a lot recently is, given his really, direct stated commitment to, I'm going to do everything he can to get inflation under control, if he were to start cutting rates as soon as the summer, which is what some of these market predictions are suggesting, would that have to be something pretty bad? Would that have to be a pretty painful breakage, and therefore maybe not necessarily something that's particularly bullish for the markets?
Probably. Where I said I didn't think he was going to hike anymore, I don't think he's on the verge of cutting. I think, now listen, had Silicon Valley Bank met the outcome that the letter of the law said it should have met going into that weekend, I think the collateral damage would have been severe, in that there would have been businesses that couldn't function quite properly. There would have been a lot of damage in, distressed sales of this, that, and the other thing. It would have spilt over, would have scared people even more, blah, blah, blah. And so that probably would have teed up enough damage to potentially say they could cut maybe in a group of months if the right data showed up. But so I think, but they're not going to get that. It'll take something else. It'll take some other kind of accident. If we get, bad, I think if earnings get bad enough, maybe this, but the stock market, I said, I think it's been pretty resilient. So unless we get an air pocket, I don't think the stock market alone can do it. I don't think the economy will deteriorate fast enough. So I don't really know if we're going to see any cuts this year, like you're saying the market is saying, but it's possible. But it would take something pretty severe, I think.
Okay. So your default is that Fed pauses for the year and lets us absorb some pain, right? I mean, it's staying at 5% or whatever, right? I mean, that's a pretty high cost of capital on a relative basis from what this economy is used to. We're going to have those lag effects, hitting us month after month, or for quarters. Powell has been warning us that, look, getting inflation under control is not going to be painless. So I guess what I hear you saying, and correct me if I'm wrong, is he's going to let us endure pain as long as it's slow and progressive, and inflation's coming down through all of that, as you said. It very well may likely for just other reasons as well, unless something really truly bad happens. And if that then does force the Fed to pivot, that's probably not a super bullish moment for.
No, I wouldn't think so. I wouldn't think so.
Okay.
Yeah.
All right. Let's just assume for a second that the Fed does pivot. Let's say something breaks bad enough to force the Fed to pivot at some point this year. Let's say the market is right. Earlier, when you've been on this program, I believe I heard you say, if the Fed is pivots before it's got inflation under control, that may be the moment where it loses the confidence of the bond market, where the bond market says, you know what, Fed, you're either a clown or you're just impotent, and we don't trust anymore that you're going to get it under control, and therefore we're going to start demanding a lot higher yields going forward for this incremental risk, or this renewed secular risk. Do you still feel that way?
Yeah. In fact, I think what we saw in the last year was the early stages of the bond market actually taking the printing press away. I mean, it did what it wanted to. It all got ascribed as predicting future rate hikes. But what happened was the bond market took matters into its own hands. It tanked. And then the Fed followed it, and then things went and they broke, and now the bond market rallied. So I think the bond market has done that to a large degree. It didn't get described that way. As I said, they always talk about the Fed in a manner that makes you think the Fed's totally in control, which I don't believe that they are. But I mean, they do have a lot of sway. But so I think that they're going to get a period to declare victory. I think this. I don't know. I think this is a decent probability. In the next group of months, they'll get a chance to kind of declare victory. Inflation will be coming down for reasons we talked about, because of the base effect. Maybe the economic data will soften. and they'll be able to say, yeah, things are going in our way. We're pausing. They're feeling good. And then somewhere down the road, something will happen and they'll start easing again. They'll have and inflation won't have been brought back down under control. And in that next cycle, I think people will be critical, and they might really lose control of the bond market. So I think the stage has been set. It's kind of already happened, but now we're going to be in a period where they're not going to be tested. That'll come again. Now, if we look to Japan, the bond market tried to take the printing press away, and they did an unlimited amount of YCC, yield curve control, and they got the yields back to where they wanted them to. And fortunately for them, the yen's rallied. I mean, the yen was tanking. They did a bunch of intervention. Now, wink, wink, nod, nod. It's pretty clear YCC is going to end one of these days. I think that's why the yen is held together. So the bond market was trying to take the printing press away from the Japanese, which is a decent place to look since they did it first and longest. Yep. And then they've won a little victory, but they're gonna stop YCC, I believe, sometime in the next group of months, next quarter or two, when the new guy gets entrenched. And then we'll see where rates go. But that will be we could look back and say, well, the bond market took the printing press away. They panicked one last time, but it forced them to abandon YCC. And now we'll see where things go. So, these things aren't like binary and happen like right next to each other. There's a time lag and events have to play out. But that's where I think we are.
Okay. That's really interesting. And so is it safe to say that maybe Japan may be giving us a preview of what you think is to come?
Kind of. It's a little bit different in that if they abandon yield curve control, which I think they will, I think the yen's going to rally. And I'm not sure if the bond market was taking the printing press away from the Fed in a visible way down the road. I don't know if the dollar would rally, but yeah, Japan's a good litmus test because they were first and biggest and baddest at doing all of this financial market intervention.
All right, and so I'm curious then, just looking at the Japan playbook, and I know we're a couple of steps down the road here from when the Fed has, after it's paused and it's gone back to hiking, and then gone back to easing, and then the bond market tries to take the printing press away again. Would you expect the next response here in the U.S. would be yield curve control, the way that it was in Japan?
Yeah. I'm still stuck with the mindset that I had of the last 30 or 40 years when we had financial markets and somewhat responsible governments. I never knew suppressing free speech would be so popular with the mainstream media, for instance. Mm-hmm. There's things I said, well, no, that can't happen. So I from a math standpoint, I can see where the government would feel the need to want to do yield curve control. It seems so third worldish or Japan-like. I can't really believe it, but we've already had NERP and ZERP and QE, so I guess they would. I don't know. I wouldn't say that they will, but I can certainly see how they could. And we have the debt ceiling may be more disruptive this go round because we've got such extraordinary contentiousness between the left and the right, although in many cases, the politicians are all the same. They're just grifters. But anyway, that's another issue. So we could have something. There's confidence. Some confidence could get lost as we rattle through this debt ceiling. I mean, at some point, people may examine carefully the fact that 30 trillion is a lot of debt, even if it is for the USA. And they might notice that the Fed is actually, their balance sheets broke, just like other central banks. Now, when you have a printing press, it's not a day-to-day problem. But if you start to have a confidence issue, I could see how those things could blend together. And we could get in a point in time where someone like Yellen, who doesn't know very much, could contemplate do yield curve control. It'd be a very bad idea. I would send the metals to the moon, I think, and there'd be ways to make money out of it. I hope they don't do it. I kind of don't think they will, but I wouldn't be at all surprised if they did.
Okay. And just for viewers that don't understand what yield curve control is, it's basically the government trying to prevent bond yields from going higher, by stepping in and just buying them all basically over time.
Yes, they say that we will buy an unlimited amount of money at 10-year bonds at 350, and then the yield can't travel above 350 in theory.
Right, and of course the price you pay for that usually is your currency really takes a whack, as the yen did relative to most other currencies at that time. You made a comment, I just want to clarify here briefly for viewers too, Bill, talking about the Fed having a balance sheet problem. There's a chart that you retweeted on Twitter I'm going to put up here real briefly,
okay. Yeah.
Showing that the Fed is, quote, insolvent to the tune of 44.2 billion. And you can see here its unrealized losses just basically plunge in the past quarter or so. Can you just explain what you mean by the Fed actually having a balance sheet problem?
As we all know, the Fed has a printing press, and it's pretty effective. It can print dollars and buy what it needs to buy, create credit and buy what it needs to buy. So thinking about them having a negative equity on the balance sheet or being technically bankrupt doesn't really mean much because they got the printing press. But it might cause the average person or the average policymaker to think twice about, well, what does it mean that central banks now they're broke? I mean, in other words, it can impact. Remember, banking is about confidence, and as we've seen, when you lose a little confidence, you can have a run on a bank, which is perversely what the Fed was set up to, stop. That's why it was created. Remember, to stop bank runs. So it's possible that we could get to a point where people don't have as much confidence in the dollar or the U.S. government, or these are very subjective variables. But as we saw in the banking system, once you start to lose confidence, it's hard to get it back, and it can spiral quickly. So if the debt negotiations bring more focus on our debts, or something else triggers a focus on the central bank's balance sheets, people might start to say, start looking at it was just a big money printing fest and misallocated capital. And then people might not be so sanguine, or financial market types might not be so sanguine with what's going on, and they may, position themselves differently. So if confidence starts to erode, and there's no telling exactly how that's going to manifest itself, but it's generally not bullish for financial assets.
Okay. All right. Well, I want to just quote you from your tweet here as we leave this chart. You say, it's a great chart, slowly then all at once. There's no practical way to leave QE or NERP without causing lots of pain.
Correct. Yeah. I mean, we're seeing it. I think I bastardized that. I think I stole that from Kyle Bass. I think he was the first one that said that. I say it all the time like I thought of it, but I think he did. Someone else did, but I think it was him. I mean, the truth of the matter is when these central bankers have been intervening aggressively in markets for quite some time, but really since QE began. And then when we went to NERP over there, NERP in Asia and NERP in Europe and NERP over here, they really distorted markets. And you once you do that, especially when you come into it with as much debt and misallocated capital as we had because of how long they did it, there's no when you go on as long as they did, there's no relatively painless way to get out, right? And so things start to break, and you just can't do it. We have too much debt, we have too much misallocated capital. I mean, look at how quickly they bailed out the unsecured depositors at Silicon Valley Bank. Now, I'm sure there's a lot of people that are really happy that they did that. And on a personal level, I'm glad that people didn't have to take pain as a consequence of not knowing how the banking system works. But on the other hand, we're supposed to be in capitalism.
Right. You
make a mistake like that, you're supposed to have to pay a price. Now, I read that, from credible sources that if we'd have gone down if we'd have done the Old Testament version of a bank failure, the unsecured depositors still would have gotten 85 or 90 cents back. That wouldn't have been great, but I would say anyone who had the large amounts of money there can afford to take the hit and should have had to take the hit. Now, I understand not wanting to see businesses pummeled and all of that. I'm sympathetic to that. But I think they could have constructed a bailout that would have stopped, individual businesses from getting destroyed because they had over the 250, and not just bailing out everybody who didn't protect themselves. Because why should I bother? Why should people bother to protect themselves and do it right if you do it wrong, you can get the benefits that they got from being, having their money at Silicon Bank, like the sweetheart mortgage loans and all the stories you read about, and then you don't pay the price. Now, the people that didn't know that they shouldn't have over 250 in the bank, I don't know. Anyway, like I said, I don't want people to take pain, but that would have been a perfect moment to try to point out that this is a capitalistic system, and when you make mistakes, like for instance, when John Corzine managed to put MF Global into the dirt, that's where I was trading my commodities, right? And I wound up selling my claim at 93 or 4 cents in the dollar. So I took a small hit because I didn't want to wait forever to get the money back, and I didn't know if it was going to come back, and it did. So, I mean, that wasn't my fault. I didn't know that Corzine was going to be able to do that, but it happened, and you just have to take the medicine, and they didn't make anybody take any medicine.
Yeah. Got a whole bunch of other questions I want to get to here, but look, in one sense, I understand the swift intervention to show the world that, hey, we're not going to let a meltdown happen in the banking system. But at the same time, to your point, it really does seem to encourage moral hazard to a certain extent, because Silicon Valley Bank had crappy risk management protocols. But why does it matter if you're going to get backed 100%? They
could have said, look, we're going to make all the corporations had corporate deposits there whole or something like that. But if you personally were an individual and had more than, I don't know, pick a number, several $1 million, you're going to have to take the haircut that you're going to have to take.
Right. And if you're a big VC company that was there, you're going to take your haircut. But if you're using it for payroll, we'll cover payroll 100% or something like that. Let
businesses get their checks. There would have been a way to handle the banking inconveniences and make sure that the only people that took the pain had, a fair amount of wealth. So they didn't do that. And that was a bad precedent, I think.
All right. Well, this is a good segue to the last question on the Fed. And then I want to get into a couple other topics here, which is, okay, Bill, through an act of Congress or God, you are now made emperor, and you get to decide what we do next with our central bank policy. What would you do?
Resign.
Okay. Yeah. Okay. You can do that after you fixed the issue.
Look, you'd have to be honest with people and say, look, we've pursued 30 years, but really the last 15 of really reckless policies. And we are going to not be able to do that anymore. And we're going to have to, I would go back to a monetarist approach, something like Volcker did, where they had a ban for the M's. You could try to do some variation of a gold standard or something like that. You have to take the seat of the pants option away from the Fed. The reason the Volcker was able to break the back of inflation was because pursuing a band for the M's, the money supply targets, allowed them to let rates float where they needed to. And so they could, they weren't directly necessarily making rates go. They said where they were, where the band had to be. And then it kind of, they set that target, but they had to sit back and see what happened. That's a soft variation of a gold standard, right? Okay. Of course, we went off that. Greenspan didn't take him long to get off that. And, then they've been flying by to the seat of their pants, forward guidance and, all these other things that they've done. And so you'd have to set this up and say, look, we have a generational problem here. And as part of that, you'd have to say, look, we're only going to let the money supply grow so much, or, because you're not going to get people back on a gold standard. And rates are going to go where they go. And it's going to be a painful couple of years. Go back and look at 80, 81 or 79, 81. But the problem is now the debt in the country is so high that you would have to force then some responsibility on the part of the Congress, which seems like impossible, right? I mean, these people are just so epically clueless because you're going to have to do something about entitlements and the crazy spending that we have and there's no cost benefit analysis on anything. And we've got so much spending, but without the discipline of an inability to rescue everything with printing more money, the government would be forced to deal with the issue. One of the side problems that the Fed has created and other central banks in their countries is by pursuing these policies that's allowed the can to be kicked while we've grown the size of the national debt to where it is now, 31 trillion or whatever. Mm-hmm. And there's been no reeling in of the programs. One of my hopes in 2008 was that we would look at the liabilities of the country and start to figure out a way to deal with Medicare and Medicaid and all these programs where we don't really have the demographics or the workforce to support these going prospectively, and those are going to cause a problem. So you'd have to sit people down and say, look, here's the problem. This is going to take a while to fix, and we got to fix it across a broad front. Now you can imagine the screaming and yelling and hate, cancellation, and all the things that would happen. It's not going to happen, but that's what you would need to do. That's what you're going to have. Eventually, we're going to have to do that.
All right. Yeah, whether we want to or not, and it sounds like, we're probably not going to get there proscriptively. It's probably going to be something like a bond market revolt or whatever that just, as you say, wrests the printing press out of the hands of the Fed.
Yeah.
Okay. Not trying to depress people, but just trying to be realistic about how we get to this.
That's not tomorrow's business anyway. That's out there ways, but that's right. Coming. I mean, so.
Yeah. All right. So on a nearer term basis, so I can't tell you how many times that I reference your giant mindless robot that I think you and Mike Green have talked about, right? How when there are capital inflows, given all the algorithmic sort of ETF buying that goes on, it just goes into a huge chunk of that goes into just a few stocks in the market, right? So as long as there's capital inflows going on, you have all this big buying pressure in these stocks that prop up the indices. We actually have seen liquidity, in recent months move upwards, and maybe that's a healthy part of the explanation for why we came off the October lows and stocks have been resilient as of late. My question for you is, are we seeing maybe a liquidity trap here for bulls? Because there's a number of things that could be resulting in a liquidity crunch, or at least contracting liquidity in the coming quarter. And let me just run through a couple of things, then I'll let you react. One is that M2 is still contracting the most on record right now. One of the things that the Fed is still tightening, right? It's still doing QT, even though it's doing with the other hand, it's helping the banks out. One thing that Powell talked about at his last press conference is he said, hey, I'm not going to promise that we're going to hike next time around. We're thinking about it, but we're going to watch, right? And then we're going to make our decision. And one new factor now is that we expect lending standards to tighten in the wake of what's happened in the banking system, and that is going to have the same effect as additional rate hikes. And so we want to watch that closely, right? Just want to mention this quick quote here. Credit standards have tightened significantly already. This is not Powell, but it's from Bloomberg. Credit standards have tightened significantly already, and the credit impulse of the economy, both in the US and Euro area, have deteriorated rapidly, according to their respective Bloomberg indices. Both are below the March 2021 low. So you have all that going on, plus you have what's been contributing, I think, to the recent uptick in liquidity has been that the Treasury, Janet Yellen, has been spending from the Treasury general account because we're at the debt limit. And those are her sort of extraordinary emergency measures that she's using to keep the economy going. Once the debt ceiling gets lifted, which I think everybody is pretty confident it's going to be, she is going to have to, by law, begin to refill the TGA. And it's going to be basically ending the flood of money, the hundreds of billions that have been going out of the TGA and forcing capital back into bonds, which might be taking some of that money out of the economy too. So do you see the potential for the sort of reversal of liquidity coming up relatively soon? And then that obviously impacts what the giant mindless robot's doing.
It could. I mean, remember the robot reacts to the flows from corporate America, not signals from the market, right? Mm-hmm. So, what the bond market does would only indirectly impact them if it changed their balance, and they don't rebalance the 60, 40, 70, 30, depending on your own target very often. So I don't know that would upset that. But again, I think this debt ceiling negotiation could be quite contentious, more so than usual. And who knows the way people are thinking now. Like I keep saying, that there could be a catalyst for some sort of different action that comes out of that. I don't know. So the whole TGA account and how this is all. I mean, the Fed didn't go at QT as hard as it could have. I think one of the things one of the first things to go for them probably will down the road when they start going the other way might be QT. And, maybe that'll happen during the debt negotiations. Who knows? I don't know.
Okay. All right. I was trying to get a sense for, do you have a concern that liquidity could start drying up here? It doesn't sound like it's a major issue for you right now.
I think the action in the market is more a function, stock market is more a function of changed expectations than it has been a liquidity function. So I don't think liquidity changed that drastically, other than the fact that the balance sheet did go up a ton, and it's not QE, even though it's not QE. So, it's hard to parse these intangible variables that are just big and amorphous, right? I don't really have a strong opinion about exactly what liquidity is going to do in the next quarter or so.
Okay. All right. Well, then let's look at some things that the market should be looking at. Like we just got the latest PMI and ISM data, and it doesn't look great. So global PMI is, it's up from February, but it's still the fifth straight month of contraction, right under 50. ISM manufacturing dropped. It's the fifth straight month of contraction and the lowest since May 2020. I just pulled those this morning right before I got on here with you. But I mean, as I sort of said in the intro, if you look at the macro data, it's not telling a super optimistic story about where things are headed here, right?
No. Again, that's why the Fed's going to be in a position of being able to pause and feeling good about themselves, I think.
Yeah, and so I guess where I'm going with this is like this morning, McDonald's just announced that they're going to be laying off thousands in the future, right? And it's because they're seeing less demand amongst lower income consumers at their restaurants now. So, it's sort of like we're seeing all these recessionary indicators here, from the inverted yield curves and, the soft PMIs and these layoffs that are now outside of big tech, and they're now getting into the general economy here. The market, you said that you think that the recent rise in the market is because of sort of changing expectations. When is the market going to look at the data and say, oh, wait a minute, maybe we got to change our expectations back because it looks like the economy is really contracting here, or at least slowing fast?
Could be during earnings season. I mean, I think earnings season will be a good litmus test for what the equity market wants to do. We'll see how bad the data has become, in Q1, and how the people running the businesses feel about the next quarter or two. Right, so I think we'll get a better sense when we get to the Q1 earnings reports, and then we'll have some sense. It's almost impossible to guess without getting to that, I think.
With getting some data from that. Okay. Yeah. And how worried are you about, and I'm getting to your general sort of market outlook in just a second, because I know that's what folks really want to hear. But, there are a couple other shoes that could be dropping in the story here. And increasingly, you mentioned this earlier, commercial real estate is getting a lot of press right now about the potential risk there. And I think one of the things that brought that to the forefront is the big banks they tend to have a lot more on their loan books in almost every other kind of credit category, but not in commercial real estate. That is predominantly owned by the smaller banks, and by the smaller banks, I mean kind of everybody who's not in the top 10.
Right.
There's it just does not look good for that market. Blackstone, who has they've been in the media a lot recently, where they had a bunch of their investors trying to get out of their big commercial real estate REIT. The number of redemption requests have now surged to 4.5 billion. But so far, they've only been able to pay out about 2/3 of a billion. And they're kind of slow rolling the ability of people to take money out of there.
Right.
They also, Blackstone defaulted recently on a $500 million bond that was that owned offices in Finland, I think, or whatnot. So it's not a systemically important American story yet, but it's showing that they're willing to just say, hey, yeah, we're not going to pay, right? So how worried are you about commercial real estate here? I know the loans themselves probably weren't as bad as loans made back before 2008.
Yeah.
But the outlook for the space, definitely, you can make a pretty good argument with, the whole remote work
Right. Yeah.
argument and the higher mortgage rates and all this stuff. It does not look promising. It looks like it's going to be hard to avoid defaults there.
Yeah, but I think that's those problems are a little slower moving because each building is probably somewhat unique and the paper on it's different and the holders are different, and those things are going to take a while to work out. But I think that's going to be a problem for a couple of 2-3 years as all that paper comes due and has to get recast and all of that. So I don't, but I think, again, when people start reading about other investors not being able to get their money, that lack of confidence and that bit of scare spreads. Like if you see, and I think it'll get worse for the Blackstone, it's going to be interesting to see how they get out of this pickle. But I think that doesn't instill confidence. So again, the problems of commercial. So the more you read about problems where this building had to get refinanced, or they sold at a loss, or they gave the keys back, these kinds of things, all of those things are net reduced confidence. And those kind of things tend to be bad for financial assets. Again, if it wasn't for the passive bid, stock prices would be much lower already, and we'd be able to look at this as it would be a little easier to analyze, I think.
Okay, so anyways, right now we've got a market that is all of a sudden beginning to feel, a little sanguine, a little more confident in itself. That said, you're saying there are all these issues here that are corrosive to confidence over time. So as Bill Fleckenstein looks out ahead here, what is your market outlook as you look out to the rest of this year?
Well, again, so there's that part which makes it that hard. There are going to be plenty of headwinds, even though they might not include more rate hikes. We got this debt ceiling negotiation. You got the disintermediation in the banking system. You got the hunt for marks that are mismarked in real estate, private equity, commercial real estate, and venture. And you got the knock-on effects of the failures we've already seen. So all of those things are net negative. And without real liquidity injection, I don't see how stock market should be able to power past those things. And earnings season ought to show us that it can't. And we should see some weakness in the stock market as a consequence of that. Maybe to be more selective. Maybe certain things that are way overpriced, like the big stocks that are carrying the entire tape, maybe they get hammered. Maybe smaller businesses that have a strong niche right now with a barrier to entry, they can do well, they can do okay. Maybe we'll get a little sorting out. I hope that happens, although given the mechanical nature of what we've talked about the passive and all that, it's hard to seem to get a sorting out process started, but it could happen. I think the stock market will have a hard time going through Q2 unscathed. And then depending on how that goes, that'll give us some idea what's going to come next, right?
Okay. Yeah, it'll be really interesting. I just heard the other day that the S&P is actually started raising 2024 earnings again. I heard back up to sort of the January 2022 peak. They're getting back up to those levels. So obviously, that's just estimates at this point. We need to actually hear the guidance from the companies, which is what you're
Right.
saying. So
And we got to see what, what the damage so far has done, and whether investors are inclined to give them a pass. I mean, Apple had a record shortfall in revenues. I think it was 4 billion, and nobody cared. Right. So, we'll have to see if people care. Again, psychology is going to enter into it when we get to the earnings season as well. Right. So we'll learn a lot in the next, in the next 4 to 6 weeks.
Well, let's talk about that for a second, because as I've been want to say for years and years, which is you don't get a market reversal without getting a reversal in sentiment first, like a cyclical market reversal. As painful as 2022 was for a lot of investors, the longtime investors like yourself that I've spoken to, they said, look, we haven't seen the kind of capitulation that you see in bottoms of a bear market. And so I think a big kind of question that's up in the air right now is, are we potentially in a bear market here that hasn't yet hit its bottom, and this is the kind of euphoric bull trap that sucks everybody back in before the bear returns? Or was last year kind of a correction and otherwise still intact bull market cycle? I'm curious if you have an opinion about that, because it seems from what you're telling me, a lot of the macro stuff suggests that macro-wise, we're going to be grinding downwards from here and not heading back to,
Yeah, I think the chance.
Growth. Our interview with Bill will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And don't forget that the replay video of Wealthion's recent and very excellent online conference is now available for purchase over at wealthion.com/conference. And finally, if the challenges that Bill has detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends, risks, and opportunities that Bill's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next over in part 2 of our interview with Bill Fleckenstein.